Central banks have actually been looking at the evolution of digital currencies and asking this question that what is the future of cash? The world is becoming more and more digital, technology is having a very important and pervasive effect on how we conduct ourselves, how we do economic transactions, and therefore in step with that technological change, cash or currency also has to evolve. And hence the next step of that evolution is a digital currency, right? But not in the form of, not in the way the bitcoins have actually evolved. So CBDC is therefore a natural response by central banks to digitize the currency and also try and bring in some benefits that the likes of cryptocurrencies have actually brought into play.
Money is an extremely abstract concept. It is central to our lives and to our day-to-day economic activities, but it is also something that is very difficult to explain. In the recent past, the simple concept of a currency itself has seen dramatic innovation with the introduction first of private cryptocurrencies and subsequently of central bank digital currencies, which have recently been introduced by a number of countries, including India. What is currency and what are cryptocurrencies and how do they function, and what is CBDC? What is the future of CBDC? What benefits does it bring? What challenges does it bring? This is the topic of our discussion today. Joining me to talk about this is Neeraj Gambhir. Neeraj is the Group Executive and Head of Wholesale Banking Products and Treasury at Axis Bank. He is a very well-known figure involved in policy circles and has contributed to many nation-building activities. Neeraj, welcome to the show.
Thank you.
Before we start, to our listeners and our viewers, if you are interested in this topic, I would also encourage you to go back and see our episode on money, which we done some time back. It talks about the evolution and history of money, which we will not cover here, but that will be an interesting place to start as well. So Neeraj, to start with, maybe just a little bit on what exactly is currency and what gives it the value that we perceive it to be.
So you started your conversation by saying that money is a very difficult concept to describe, right? In economics, it is said that money is what money does, right? So what does money do?
Right.
And typically in economics, we look at three fundamental, roles that anything which is called money plays. So first of all, it's a medium of transaction. So you and I, when we transact, we exchange value. We exchange value by paying each other money, right? Goods in exchange of money. The second, function that money performs is store of value, right? So it's basically something that you use to store value for a future consumption purpose, right? The third is money is a unit of account. So we measure the value of things in terms of money. So these are the three fundamental, roles that money is supposed to perform. And therefore, any object, any commodity, anything which helps performing each of these three functions tends to have an attribute of money, right? I'll not delve too much into this detail, but the role of money evolved from in terms of difficulty that people had in the barter economy. So it was an evolution from a barter economy to a more sophisticated form of trade and commerce. And over a period of time, money has taken different shapes, different forms, right from animal hides to cowrie shells to, over a period of time, I think precious metals, which is gold, silver, ended up becoming the dominant form of money all over the world. So we will start our story from the transition from gold to paper currency,
Sure.
Right? Which is the form of currency that we all use today. So gold has been a dominant form of money in the history, almost 300, 400 years. There used to be a concept of coins. So coins used to be sort of minted in gold. So therefore, the total amount of money prevalent in any society or any economy used to be a function of the amount of gold that is available in that economy. So if you suddenly found a large, gold, or you went and sort of looted some other country and you kind of got their gold, so suddenly money in your economy went up because the total amount of gold available went up. So while gold is a private commodity, but the concept of coins was basically a sovereign subject. So only sovereigns, kings and kingdoms used to mint coins and circulate those coins, right? So, but it was fungible in the sense you could take a gold coin and actually melt it down and make ornaments out of it, right? So, and that was kind of what defined the value of the gold. So because gold is fungible in the sense you can make a coin out of it, you can make an ornament out of it, that's what kind of ended up giving gold its value. Also what gave gold its value was the fact that it is in some senses a rare commodity, right? Even till date, the total amount of above ground gold is estimated to be about 200,000 metric tons. So that's actually a very limited amount of gold that's available in the world. So it's kind of a scarcity value that also created some kind of value for the gold. Now, as the world transitioned from sovereign states into elected governments and democracies, right, the whole concept of money also underwent a change. Notably, the biggest change happened somewhere around, I think, early 1800s, when the concept of paper money started gaining ground. And how did the concept of paper money started gaining ground? It was basically gold is a bulky and heavy commodity, right? It's difficult to carry. Let's think about this. If you are somebody who is a person of repute, and I give you gold to deposit, and you in exchange give me a piece of paper that you have X amount of gold on my behalf with you, and I can take that piece of paper and I can actually use that piece of paper to buy stuff, to buy things, then that piece of paper is actually working as good as gold, right? Even though I'm not carrying the gold with me. So paper is easier to carry as compared to the amount of physical gold. You can have enormous amount of physical gold backing a simple piece of paper. But think about this, the piece of paper is actually an IOU. It's basically saying that you owe me the gold that I've deposited with you, and I'm using that IOU to actually then go around doing physical economic transactions. That's how the concept of paper money started. So it was basically a form of IOU by certain sets of people, which started getting accepted in the economy as a means of exchange, as a means of making payments, and from there the whole concept of paper currency originated, right? And this was basically in the context of trading and commercial transactions, right? So in trading and commercial transactions, if you're using a piece of paper, then that piece of paper becomes transactable, tradable, it can exchange hands instead of physical gold. Over a period of time, so think about this, gold is something which is physically available, anybody can have gold, but the power to mint currencies was limited to the sovereigns. Right? But paper can be printed by anybody. Paper can be written by anybody. So effectively, anybody can be, if that paper is available or that paper can be used to do economic transactions, then effectively anybody and everybody can become a issuer of currency. Right? So that was the form of paper currency in early days.
Right.
Anybody could issue a IOU, and that IOU could be used to transact money. But that led to its own set of problems, right? Because it can obviously lead to frauds. There can be issues with regard to the value. Values can deplete. So trust is always an issue in these kind of currencies. So you started limiting the ability to issue such paper currencies, which can be used in economic transactions to a certain set of people, and those became banks, right? So the initial phase of paper currency was paper currency issued by various banks, but it was in some senses always tied to the fact that behind that paper currency, the bank is holding a certain amount of gold or some such commodity, right? So this is a gold-backed paper currency time. Now, banks can actually, there's no control, right? Banks can issue multiple sets of paper currencies. The paper currency traded a far rapid velocity as compared to the amount of gold trading that can happen. So this created its own set of issues in terms of the sudden creation of wealth in the system or money in the system and depletion of money in the system, right? So it subjected the system to a lot of volatility, a lot of booms and bust periods, because suddenly the banks were very egregious in terms of issuing paper currency. You had a boom period. Suddenly some bank went bust because they actually, there was a fraud and they actually did not have the adequate amount of gold backing their currency. People lost trust in that bank and suddenly you had a bust period. So to control that boom and bust cycle of, uncontrolled money creation by the banks, the paper currency issuance process got centralized in the hands of central banks. I've actually, taken the history of the money and the paper currency of about 400, 500 years and compressed it into a few minutes of conversation. But this is where we are today. We are today at a stage where in most countries, I'm saying most countries because we still have some countries where more than one bank can issue paper currency. In most countries, the paper currency is issued by the central bank of that country. Right? Up until Second World War, the issuance of this paper currency by the central banks was always tied to the amount of gold that the central bank had, right? So it was effectively a currency which is backed by gold. Effective the end of Second World War, when you have Bretton Woods Agreement that came into play, central banks kind of dissociated the issuance of this paper currency from the amount of gold that they are having in their vaults, right? So in some senses, the peg of the paper currency with the gold was broken.
Yeah, in the 1970s, I think this happened with Nixon. Yeah.
And basically, over the last about 40 odd years or 50 odd years, we are in a currency regime all over the world where central banks are now issuing paper currencies and metal coins. The value of these currencies and metal coins is not guaranteed by the amount of gold or any other physical commodity that the central banks hold, right? It's just a piece of paper. So the natural question to ask is that if it's just a piece of paper, why does it get accepted for as a currency? Why do people have trust and faith in it? And the reason is that in most economies, most jurisdictions, there is a force of law behind it. The force of law says that the paper currency issued by the central bank is to be accepted as a means of exchange and is to be accepted for repayment of debt by the force of law. And if you refuse that, there are criminal liabilities. Even in India, it's the same story, right? So if you refuse to accept physical paper currency issued by the Reserve Bank of India in exchange of, for settlement of debt, you are actually committing a crime. And because there is this force of law of the government, these paper currencies are today called fiat currencies because it's a currency by fiat. It's not a currency whose value is governed by or whose value is driven by the amount of gold that the central bank is holding. So what does this transition from gold to paper currency or gold-backed paper currency to pure paper currency actually helped? This transition from gold-backed paper currency to pure paper currency basically helped central banks to manage the amount of money available in the system, money supply available in the system at will. Right? There is no constraint now. It is not limited to the amount of gold that the central bank has it in its possession, right? So the central bank can now actually help the banking system create broader money or actually leave the amount of cash in the system depending upon its judgment of how much money is required in the system to facilitate economic transactions or economic output. Now, if you think about this, it is a system which can be subject to very significant misuse by the governments because at the end of the day, central banks are effectively arms of the government, right? And any government can actually end up printing too much money, flooding the system with too much money, which in the short term will create a lot of happiness in terms of wealth creation, but over a longer period of time, the value of that money will get destroyed, right? And that concept of destruction of the value of money is inflation, right? So effectively, if a government misuses or overprints the amount of money in the system, it creates too much inflation in the system, and effectively the wealth gets destroyed. In order to protect from such outcomes, most market-driven economies have actually come up with the concept of central bank independence. We just said that central bank is effectively arm of the government, but what they have basically tried to do is separate the role of creation of money and credit in the system from day-to-day government management and from the government of the day by carving out the role of a central bank, giving it legal independence in the law so that it can conduct the policy in such a way that it protects the value of the paper money that you and I use every day. And that's the inflation targeting framework that we're talking about. So again, this whole concept of money being something which is valuable or which is backed by a valuable commodity, to money being something which is just a piece of paper today, but backed by law, both in such a way that it has to be accepted in economic transactions, and the law creates a money creation authority or money management authority who is tasked with making sure the value of money is not destroyed over a period of time, is roughly a last 50 years concept and phenomena. Great. I hope I've kept.
Great. No, I think Neeraj, we've covered like a very vast period, and you summarized it so well for us. So, just to put it very simply, money historically has been a mean of transfer. Many items played the role of money, most popularly gold, because gold is so widely accepted, and everybody values gold, and so it was easy to kind of put some value on a piece of gold, and so that became a mode of exchange. Over time, economies realized that actually transacting gold is not that easy. So they basically kept the gold in a vault, and they said, I have so much. They put paper against it, right? It's almost like the ETF of today.
That's right.
That you say that there is gold in the vault and I have so much. This paper represents 1 rupee out of the 100,000.
A similar concept in today's world will be the warehouse exchange receipt.
The warehouse, yeah, exactly. Something of that nature.
Yeah.
And so that became a way of transacting. And then somewhere in the 70s, kind of economy said, look, we are being constrained by the increase in supply of gold to be able to issue more currency or more money. And so we want to break this peg. And then basically they said, look, trust me. I am the central bank of this country and I'm the government of this country. Trust me, this piece of paper is worth rupees 100. And
I will nuance this by saying that it's not just the trust, it's the force of the law.
Yeah, trust me, and the force of the law. So
yeah.
it's the trust in the law,
right,
at some level, that now ascribes the value to that piece of currency. Right. In fact, we'd shown this in our episode on money. If you look at any note, a 100 rupee note, let's say, the note basically says, I promise to pay the bearer of this note a sum of 100 rupees. Right, which basically means that the note itself is not 100 rupees. It is something that is worth.
Well, that's my favorite exercise with the first year students of any any management or economic course. That what is money, right? What do you have in your heads? It's a promise to pay, but promise to pay what? 100 rupees. But this is 100 rupees.
Yes.
So it's a circular logic in some senses.
Correct.
Right.
Correct.
But that's basically what it's basically a piece of paper issued by the central bank. Of course, it has got its security features so that it cannot be easily forged and counterfeited. But at the end of the day, it's a piece of paper, and that piece of paper carries the force of the law. And if you don't comply with that force of the law, you can be put behind bars. And obviously, there is this whole concept of that it is issued by the central bank, it is backed by the government, so that creates some kind of element of trust into that.
Absolutely. So this is a great, I think, starting point for us to move into the next part of the conversation, which is what are these cryptocurrencies?
Yeah.
What is Bitcoin, let's say,
Yes.
because that was the first one.
So you think about the concept of today's money.
Right.
The concept of today's money is actually twofold. It's one, the piece of paper that we all carry in our wallets is the physical currency. And second, it's basically bank accounts. That's the main form of money, right? And over a period of time, as the world has become more technology oriented, as life has become more digital, it's the bank account driven payments which have overtaken the physical cash driven payments, right? So today, even before it became digital, a lot of the value used to be exchanged by writing checks on bank accounts, right? So effectively, if I have to buy something from you, I'll write a check on a bank account, you'll go to the bank, you'll present the check, what will the bank do? The bank will transfer certain balance in its ledger from my account to your account.
Right.
Right? So it's a ledger transfer in the bank's books. And that's what money is, right, today. It's bank deposits, it's the currency that we have in our hands. And large part of it is actually the bank deposits. Right. So effectively, you're dependent upon a bank to tell you how much money do you own. So today if I were to ask you, what's your bank balance, right? Even if you have been meticulously keeping an Excel worksheet or a physical paper of all the money that you have earned and spent in that account, that means nothing. If you have to figure out how much money you own in a bank account, you have to go to a bank and ask him, tell me how much money do I who I own in this account, and the bank will give you a statement, which used to be called passbook earlier times. Nowadays it's all digital, but effectively the bank is telling you, as per its records, how much money of yours they have, right? How much is the bank balance that you have, and that's why it's called bank balance. Effectively, you are dependent upon bank and bank systems to tell you the. So there's a trust element. The bank has to be honest, and the bank has to tell you the exact value as per its records of the amount of money that you're keeping in it, right? Somewhere in 1980s or early 1970s, people started toying with this idea of, why do I need to have a central authority like a central bank or a depository institution or a trust institution like a bank to decide how much money do I have, right? You're very dependent upon the central bank and the banking system. Can we have a form of money which is not dependent upon these two kinds of institutions, which is independent, in some senses going back to the gold concept, which is independent, and can we do this digitally rather than doing in a physical way, because the world has become a digital. So you had this great experiment which was called the digital cash experiment in 1980s. I think it was Citibank which came up with this concept. But and I'll not go too much into the theory of this, but there was this whole constraint of being able to come up with a form of digital currency which is not dependent on anyone, right? And in the context of technology, it is called distributed ledger, which basically means that we are not dependent upon one person to tell us what is the amount of money or balance that is there. It's something the whole system knows, right? This kind of turned out to be a computationally complex problem to solve. That how can we come up with a ledger which is publicly maintained and it is not dependent upon a single institution. And if you think about this, there is a bit of a libertine stroke anarchist thought process behind it. And the libertine anarchist thought process behind it is to say that we don't trust the governments. We don't trust the government institutions to manage and retain the value of the money. Therefore, we need to have a form of money which is independent of the government, right? Now, this hard problem of finding a data structure where you can have ledgers which are not dependent upon a single central authority was solved in a 2007 paper by an unknown guy called Satoshi Nakamoto. And the idea was to come up with a data structure called blockchain, right? So true innovation of this was that blockchain allowed you to create a distributed data structure which did not require a central authority to maintain it. The way the blockchain was designed, you could actually have a distributed data structure which kind of worked on its own, and you could question anybody who's holding the ledger to figure out what the true value in that ledger is. And it had some kind of protocols built inside to make sure that there is consistency in the entire database. Also, very importantly, this was driven by the concepts of cryptography to make sure that the information has protection, security protections in it. And it was also driven by the concept of applying a certain amount of computational effort, computational energy to come up with a currency, right? So this whole concept of a blockchain-backed currency, which is in a distributed data structure, data ledger format, uses cryptography, hash algorithms to ensure security, uses computational power or computational effort as the concept to reward currency creation, was called Bitcoin. So today's Bitcoin was the first such experiment where the world succeeded, where basically we succeeded in coming up with something which can be considered as a completely independent currency of any central authority.
Right. So if I were to draw parallels, in the physical money, piece of money is issued by a central bank. So the central bank can decide, today I want to do so much, and tomorrow I want to do so much. So sometimes it can issue a lot, sometimes it can issue a little bit. It is based on certain policy objectives of the country and of the central bank. And so the central bank issues the money. The second is the trust in the money. You and I will believe that a 100 rupee note is worth 100 rupee because, as you said, the force of law and the confidence behind the central bank and the government that they will hold their promise. And thirdly, if you were to, who is saying that Neeraj owns 100 rupees or Samir owns 100 rupees? It is the money in the bank, or it is the currency in your wallet which ascribes ownership. In the cryptocurrency space, there is no central authority which is printing bitcoins. Actually, there is only a finite amount of bitcoins that can ever be printed, and to mine a bitcoin, that's what they call it, which is kind of getting a new bitcoin into the system, is called the mining activity. To mine a bitcoin, you have to do a certain amount of computational effort, tasks, and so it requires you to do some work to get that money, and the amount of work actually increases with time, so it becomes incrementally.
I'll come to those properties of
Sure.
Bitcoin. I think
Sure. Nonetheless, where I'm going is that it is not a central bank which is printing. It is this distributed set of people who are bringing bitcoins into the economy, and because it is mathematically has a cap and so on and so forth, you can't do infinite printing of bitcoins. So that's number one. Number two, the trust in Bitcoin comes from the fact that, or supposed to come from the fact that A, it is finite, so you can't just print infinite numbers. B, it is a very distributed system, and so there is no one individual who can influence or commit fraud or whatever, right? Like find ways to benefit from that system. And because it is so distributed, there is trust in the system because of the distributed nature. And the third one is in terms of what is the proof that this Bitcoin is owned by Neeraj or Samir, is basically the distributed ledger, which is as you said, it's a blockchain. And every time I transfer something to you, a record is created in the kind of the
blockchain.
chain.
Yeah.
In the blockchain, an element is added, and this is certified by a very wide set of people again. And because it is done in that fashion, even this is non-disputable. There can't be any. And so these are two different ways of doing the same thing. One is centrally managed by central banks and governments. One is a distributed public network. But the two intended to start, like the cryptocurrency world, intended to play the same role that currencies play in the economy.
Yeah. So, you've gone a little ahead in terms of the concepts that I was kind of thinking through, but let's just kind of walk through each of these concepts a little bit. So the first concept that we talked about in the digital currencies is that you need to have a distributed ledger, right? Or rather, difference between a traditional currency and cryptocurrencies, it's largely a distributed ledger concept, which means that there is no single ownership of the ledger. The second, it's an algorithm, and nobody owns the algorithm. The community owns the algorithm. Community decides what changes can be made to the algorithm. That's the second defining feature of a digital currency. The third feature of a digital currency is that the concept that you talked about, that there is finiteness to its amount of currency that can be minted, right? And they use the word minted, borrowed it from the traditional minting of the mines, that what you do in case of gold, you mint gold from the mines. But actually it's not minting of any kind. It's essentially creating a new currency token by doing some computational effort, right? And that computational effort requires power. So for you to create a new currency, you need to do a computational effort that requires power. Power is expensive, so money needs to be spent. So creation of a new digital currency or a new Bitcoin is a computationally expensive affair. And the way the algorithm of Bitcoin was designed was that this computational effort increases substantially over a period of time, right? The third defining feature of this is that anybody can do it. You could be running a Bitcoin server at your home, having the full blockchain, and you could be minting Bitcoins. And as long as you are able to successfully use the computational power to solve the problem that Bitcoin carries internally, you mint a new Bitcoin and you get rewarded with it. So this is, again, not centrally issued. There's no central authority to issue the currency. The whole system actually, in some senses, competes to solve a certain mathematical problem, and whosoever is able to solve that problem is rewarded by issuance of a new digital currency. Most of the concepts of digital currency that we're discussing here are Bitcoin concepts. There are other concepts as well, so I'm not going to make it more complex than this, but these are Bitcoin concepts, right? So that's the other defining feature. The defining feature is anybody can mint it. Anybody with enough computational power can mint a new Bitcoin. The other thing that you touched upon was basically how do we verify how much Bitcoin are there in the system and how much Bitcoin you own. Think about Bitcoin is basically a very large distributed data structure. I don't know how many outstanding nodes. I think there are thousands and thousands of outstanding nodes. Each node is basically anybody who's running a Bitcoin server and has the full Bitcoin ledger or blockchain in it. You can go and query any of these nodes to figure out what is the balance of Bitcoin that you own in your wallet. And whatever answer that one node gives you, you can cross-verify across the system. In fact, the way the data structure is designed is that you can cross-verify it within that node using certain algorithms, right? So effectively, the veracity of how much Bitcoin you hold in your wallet is not dependent upon one single node or one single point in that distributed data structure, right? So this is the third defining feature. So now if you start comparing between the traditional currency and a digital currency, a traditional currency is something that is centrally issued by a central bank. Its value is guaranteed by way of fiat or rule of law or the trust that people have in the central bank. It depends upon creation of a banking system, right, which multiplies that value to create money in the system, and you are dependent upon the banking system to tell you that how much balances you have with you in terms of money. And the central banks are tasked to make sure that the value of this currency does not erode over a period of time, and they do that by managing the amount of aggregate money supply in the system or interest rates, etc. Digital currencies, on the other hand, not dependent upon a central authority, community-owned algorithm, community-owned databases. Use of cryptography to ensure that the algorithms, the veracity of the data in the algorithm is maintained, right? Or the integrity of the data in the algorithms that the algorithms manage is maintained. The amount of issuance that can be done is also dictated by the algorithm and not by a single authority, right? The amount of, in some senses, the amount of new issuance of digital currency requires a certain amount of physical effort, power, energy, and that's expensive. It costs money. At the end of the day, very fundamental difference is while you have a piece of law which forces you and I to accept a central bank issued currency, in the digital world there is no such thing. It's all faith.
Right.
It's all trust, right? So if you trust that Bitcoin is something which will retain its value over a period of time or its value will increase, you own Bitcoin. Nobody forces you to own Bitcoin. Nobody forces you to use Bitcoin or similar digital currencies in any payment, right? So it's all it's independent trust that you are imposing in the system, right?
Right.
So these are some of the fundamental differences between a physical and a digital currency.
Right. Now, Neeraj, this sounds great, right? But obviously it has its own challenges. You mentioned that it is a little bit of anti-establishment type thinking. So what, like, if say, so two, I think we take two parts. One is what happens if cryptocurrencies do become a major part of kind of currency, and the second is they haven't actually if you think of it, no cryptocurrency has become a currency. And so what, like, we'll go down that route separately, but let's first take this and talk a little bit about if indeed, let's say, Bitcoin were to be accepted as a mode of transaction globally, then what challenges does it pose to citizens, but also to governments and central banks and the like?
Obviously, digital currency is an alternative to traditional, currencies. We've come to a stage over a period of time in the history of money, where now central banks and the governments have a monopoly on issuing money, right? And they control the supply of the money. They control who can deal with the money, so by way of banking licenses, etc. And this monopoly power has a lot of value for the government, right? This value is derived by way of, number one, you recall we discussed this concept called seigniorage. Seigniorage is nothing but the revenue that the government describes by issuing currency which does not carry any interest, right? So the larger the amount of the currency in the system which does not carry any interest, it is effectively an interest-free loan that the government takes from the public. And the value that the government has by way of not paying interest on that is what can be called as seigniorage. The moment this monopoly of issuing currency goes out of the hands of the governments and the central banks into private hands, that seigniorage income will vanish, right? I'm just kind of using an extreme case where digital currencies or currencies in the nature of Bitcoin were to replace the traditional currencies. The second is that the second value that the governments derive is that they have this ability to manage and control the economic booms and bust periods by controlling the money supply, right? So they can actually smoothen the path of an economy over a period of time by managing the money supply. And if this money supply was not manageable by the central authority like a central bank, you would lose this control, right, on how an economy does over a period of time. So any elected government, in any democracy would not like to lose that power or control. I don't think we've reached a stage where these digital currencies have matured enough to start posing that level and scale of threat to the central bank issued currencies. But clearly it is not something which is unthinkable, right? Over the last 15 odd years, since Bitcoin was introduced in 2008 and we are in 2024, so about in the last 16 years, the amount of acceptance that Bitcoin has seen and the amount of increase in the market value of Bitcoin and the other digital currencies that has happened is actually quite phenomenal. It is a matter of concern for all central banks all over the world and all governments all over the world that such an important aspect of managing a country and an economy, which is money, the moment they lose control over it, right? So that's the, I think, what's the single main threat that digital currencies have to traditional currencies.
Right. And I think if you think of how the economy is managed, there is the fiscal side of the economy, which is how much government spends and so on and so forth. There is a direct impact there because governments may not be able to spend as much if they are not printing the currency. There is also a monetary side wherein the interest rates and money supply, etc., is determined by some central body. In the case of India, it's the FBC, which is kind of governed by the RBI and so on and so forth. And they decide what the interest rate should be and how much money should there be and so on and so forth. And they do it, the way of transmitting that interest rate is through money, which is what is the rate that the RBI charges banks to borrow from it, or the other way around, how much will RBI pay banks to keep money with them, is what determines monetary policy. And that also will be under direct threat because if there is kind of no money, then there is no way for you to control the interest rate. So some fairly fundamental aspects of how the economy is managed could be under threat. provided obviously that we are talking about a world where cryptocurrencies replace a majority of or all of physical currencies, which is obviously kind of we are nowhere in that, but that's in that zone. But that's the worry of central banks and governments. Great. So then, Neeraj, moving on to the next one, which is if cryptocurrencies have such great power and such great, like the conceptual clarity there is quite amazing actually if you kind of think of it, and in many ways it can bring lots of benefits if they were the mode of exchange. But in reality, no cryptocurrency has become a mode of exchange, right? They've actually, if you were to take a lens, you would say that they've actually become assets. They've become financial assets,
Yep.
and people are holding it more for appreciation of value rather than trading. And actually, one of the fundamental properties of a currency is that it's very kind of stable, right? It's not very volatile. It's priced. It's kind of value doesn't fluctuate and so on and so forth. So cryptocurrencies seem to be doing the opposite of what they were supposed to do. So what happened?
Okay, let me just delve a little bit into this asset versus, medium of exchange kind of a property. If you think about this, for a large part of our existence, say about 4,000, 5,000 years, what has acted as a currency is an asset,
Right.
right? It's physical commodity, it's an asset, right?
Right.
That has acted as whether it's an animal hide or a cowrie shell or a gold or, some other form of currency. I think they've all been physical commodities and hence something whom you can touch and feel, and their assets, right? So the concept of a paper, which is basically an IOU, somebody's IOU to somebody else, right, as a currency, is a relatively new one,
Right.
about 50 years old,
Right.
right? So I'm not surprised that the digital currencies do not work on an IOU concept basis, because IOU definitely means that it's a liability of someone, and that someone has to be trusted someone, right? Otherwise, why would you accept that
Correct,
person's
somebody's
liability,
liability.
right? So therefore, the alternative to the current currency is again going back to a concept of an asset is not a surprise to me,
Right.
So effectively, which is why you see in popular media and in many commentaries, Bitcoin is compared with digital gold,
Right.
not digital dollar, right? Or not digital euro in that sense. It's considered to be a digital gold because, again, it is nobody's liability. A dollar is somebody's liability. A digital gold is nobody's liability, or
Right.
it's effectively, so it's a liability to an asset, right? Now, obviously, as central banks have managed their currencies, and they've done a pretty good job of managing their currencies, I would say, relative volatility in the currency values has come down very sharply over a period of time, right? So if you think about this today, dollar versus euro, dollar versus yen, dollar versus INR, these currencies do not fluctuate so much in relation to each other. They do not fluctuate so much in relation to their value with gold. The general fluctuation is about 5, 7, 10%. Bitcoin, on the other hand, has seen a very significantly high volatility in its value, right? And part of that volatility in its value can be ascribed to the fact that it is still a very small set of people in the world who believe in Bitcoin, right? It's still a very small community who's actually holding, trading, ascribing that value to the Bitcoin. It's not something which is popularly held. It's not like gold, which is popularly held. It is not like dollar, euro, or even our currency in Indian rupee, which is popularly held, right? So the involvement of the section of the society in Bitcoin or other digital currencies is still at a very limited scale. Second, as the concept has evolved, people have understood the concept, right? It has actually undergone a lot of psychological, ups and downs in people's mind. Is Bitcoin good? Is Bitcoin bad? There are also these notions around Bitcoin that because it is unfettered, no rule of law applies to it. It is a community-owned initiative and it's a community-managed initiative. There is no checks and balances on how and when people can use Bitcoin. It has been used in all kinds of criminal activities. It has been blamed to be used by terrorists, for example, for terrorist financing. It has been blamed to be used by drug smugglers. So there is no real check on how Bitcoin can be used And that has also impacted the value of Bitcoin over a period of time, and digital currencies over a period of time. We've also had frauds, right? We've also had cases like FTX, where a very large exchange actually just went down, and suddenly you realize that all was not good behind that. So I think people's faith in Bitcoin has also actually gone up and down over a period of time. I would say that this is, compared to the history of any other currency, 15 years is a very, very small period of time in any innovation's life for it to fully realize its value, right? I think so. It's kind of very early stages of digital currency evolution. The world is experimenting with it. There is a certain set of community which is experimenting with it, and that experiment is evolving over a period of time, and hence people's faith and understanding of digital currencies is also evolving over a period of time. It does not have the stability and the time that physical currencies and paper currencies that have had over a period of time.
Right. So obviously it's kind of evolving and so on and so forth. Having said that, just the fact that the value is so fluctuating and fluctuating around a rising path, right, means that people would rather hold the Bitcoin than exchange it for something. And so at least at this point in time, except for some of the illegal activities where folks don't have much of an option, right? Like if you were doing some of the, I mean, I'm not saying that you would, but whoever is doing some of these things, they don't have the option of exchanging dollars, etc. They find Bitcoin as a great way of trading, but otherwise it's not become a mainstream currency, or even forget mainstream, even an experimental.
So I think the benefits of a digital currency also bring with it in its own fold the disadvantages in some senses, right? So one of the benefits of digital currency is that you don't require a central settlement system,
right?
Like you require a clearing system in case of checks. You require a central bank ledger in case of central bank money. You don't require a central clearing system in case of Bitcoin. Everything happens on the blockchain, right? Everything happens then and there, and the blockchain has its own benefits and disadvantages, but you don't need anybody to confirm a transaction in some senses, right? It's also global. It's not owned by it's not owned in a single jurisdiction, right? Bitcoin wallet is just an address, right? As long as you have the address and the password, you have your Bitcoin wallet, and you can operate that wallet sitting in India, London, New York, Singapore, Paris, wherever you go, right? So it's global in that sense. So that ease of using Bitcoin has actually lent itself to multiple use cases. Illegal activities is one of those use cases, right? Again, anonymity is also another feature of Bitcoin which has actually been pretty useful. So all in all, like I said, the use cases and the use is still evolving. There was an accelerated growth of the use cases before you had some of the Bitcoin related blow-ups, frauds and blow-ups, and then it felt like that things are kind of died down. But now with Trump coming back, and now there's this talk of US taking a lot more positive view of cryptocurrencies, this story is back into the game. So it's gone through its own ebbs and flows, and I think that will happen with digital. That happens with any new innovation, right? It'll happen with digital currencies as well. I think the full evolution of digital currencies is still some time away. Right? And during this evolution, I think many things can change. One of the reasons why the value of Bitcoin has actually exploded over a period of time is that the way this algorithm is designed is that the total supply of Bitcoin is constrained, and it falls rapidly over a period of time. So obviously, as cryptocurrencies have become popular and have started to become a little bit mainstream, the number of users who have wanted to have Bitcoin has actually increased quite rapidly. Initially, it was individuals, no institutional involvement, but over a period of time, with the setting up of cryptocurrency ETFs, cryptocurrency funds, you have started to see institutional involvement in digital currencies. And my sense is that if US actually goes down the path that Trump has indicated, that they will basically be far more supportive of cryptocurrencies, they'll be enabling law and provision, you could see the institutional interest in cryptocurrencies grow even further. So it's a classical case of demand versus supply. The supply is coming down, at least in the case of Bitcoin, and the demand is just kind of is going to grow very rapidly, right? And therefore, the belief that if US was indeed to follow the kind of regulation that they're talking about, the cryptocurrencies, the Bitcoin value can actually go up to, I don't know, maybe 5x, 6x of where it is currently. And hence, like any rapidly increasing, value of an asset, it has attracted a lot more speculative interest. It's been a self-fulfilling prophecy in that sense, a very virtuous cycle for digital currencies, right? But we have seen this interest in digital currencies go up rapidly and come down rapidly. And that significant, public interest and public aversion has actually caused its own ups and downs in the value. Like I said, it's still a very early phase of digital currency evolution.
Right. So, Niran, moving on to the next phase of our conversation, which is then coming on to CBDCs, which are central bank digital currencies. So, what was the origin of CBDCs and where did they come from?
Yeah. So I think there's two parts. We've discussed the whole concept of a currency and a cash in physical format, IOU, note format, and the digital format. Payments have actually been digitizing for almost 50 years now, right? We've had wire transfers for a very long period of time. We've had the concept of, SWIFT-based payment systems for almost like 50 years, 60 years now. So payments per se have been digitized a long time ago, right? And the entire digitization of payments has actually happened on the back of banks adopting technology, right? So it's basically banking systems technology adoption, which has converted what was basically a check-based payment system into a digital payment system, right? So I would say the evolution of digital payments precedes the evolution of digital currencies, right? So payments are very far down on that path. Even in a country like in fact, India has been at the forefront with the UPI and the IMPSs of the world, right? So you would ask this question that if payments are already digitized, what value will we get by digitizing currency? Because, if I can do digital payments, then why the hell do I need a digital currency? Even if it is a currency sitting with the bank, how does it matter? Well, it matters to a certain set of people from the concept of who owns or who issues, who controls the issuance of this currency. But for an ordinary individual, I think it really is not that important, right? Central banks have actually been looking at the evolution of digital currencies and asking this question that what is the future of cash? We've seen money or cash evolve from a coin, a gold coin or a gold currency, into a paper-based currency. That is the biggest form transition that cash has done over the last, I would say, 500 years. So the question that is being asked is, what's the future of this, right? Why cannot this also be a digital concept, right? And that's where CBDCs have kicked in. So CBDCs, in my mind, have kicked in driven by 2 or 3 different motivations. First motivation, obviously, central banks have looked at the evolution and the growth of cryptocurrencies with a lot of concern and have not really liked the fact that something on which the governments have the monopoly is getting privatized in such a rapid fashion, and it has implications on multiple things, right from their revenue, seigniorage, to their ability to manage the economies. The second aspect the central banks have actually understood is that the world is becoming more and more digital. Technology is having a very important and pervasive effect on how we conduct ourselves, how we do economic transactions, and therefore in step with that technological change, cash or currency also has to evolve. And hence the next step of that evolution is a digital currency, right? But not in the form of, not in the way the bitcoins have actually evolved. So CBDC is therefore a natural response by central banks to digitize the currency and also try and bring in some benefits that the likes of cryptocurrencies have actually brought into play. One of the biggest advantages of cryptocurrencies is that because it is a global asset, the underlying infrastructure and the architecture runs globally. There's no central government, there's no individual authority managing it. It is an efficient way of making cross-country payments, right? If you need to make a payment to someone sitting in America, you just need to transfer money out of your wallet into his wallet on Bitcoin chain, and that's it. It is done. You don't require a bank, you don't require a wire transfer, you don't require a SWIFT, you don't need to pay for transfer charges. It's as efficient as that. And cross-border payments in the traditional banking system are mired with all kinds of inefficiencies. There are high charges. It's a very slow process. There are all kinds of issues in terms of delays of payments. And you are also dependent upon the recipient actually having a bank account. Right? So in some senses, CBDC is also a response by central banks to say that if we make cash digital, can we get over the problems of the bank-based cross-border payment system? So effectively, in some senses, it's a threat to the banks in the sense that it is an answer to the inefficiency of a bank-based payment system that central banks are also thinking about CBDCs, right? So the motivations are two or three, but it is kind of, it's a concept, it's a process at this point in time.
Understood. Now the CBDC will obviously kind of you having money in your bank account versus you having CBDC in your wallet versus you having cash in your physical wallet. If you kind of think of the parallel, so the cash in the wallet and the CBDC in your mobile wallet are actually not bank liabilities, which means that it's not kind of a bank is not your money is not with a bank like your savings account balance. Actually, it's a central bank liability, so it is kind of your contract with the central bank, and hence one of the implications of the CBDC is that if it does take off and it's so CBDC could replace the physical cash, CBDC could replace the savings bank account. In the latter case, it also shrinks the bank's overall balance sheets. So kind of some thoughts on that.
Yeah, I think, again, I will just take a step back to, let's think a little bit about digital currencies, the likes of Bitcoin, are in the domain of assets,
Right.
Digital assets, right? They're not anybody's liabilities. It's like gold. It's like animal hide, or it's like cowrie shells, right? The concept of currency and in some senses money today is dominated by somebody's liability, whether it's a central bank's liability or whether it is a bank's liability. What is the central bank's liability is the note that is sitting in your wallet, right? What is the bank's liability? It's the bank balance that you have through which, or the bank account balance that you have through which you make payments for various kinds of, purchases, etc. that you do. CBDC is an extension of a liability concept. CBDC is not an asset concept as it is seen in the digital currencies. So the CBDC thought process is that money still continues to be a liability of a central bank, except for that money being issued in the form of a note, a piece of paper. That money will now be issued in the form of a wallet balance which sits on a device that you have, whether it's a mobile device or largely mobile devices, right? So think about this. The money that is sitting in your wallet, now we digitize it and we put that wallet inside your mobile device, right? It still continues to be central bank liability. It's different from the bank account that you run. Because that bank account is a bank's liability, money in your wallet is central bank's liability. Just think of it a little bit in an extreme case. If, heavens forbid, if you have a bank account with the bank which was to go bankrupt, you lose that money. The bank gone, the money gone. The cash in your wallet does not vanish, because the central bank will always be there, right? Therefore, the cash in your hand provides you a different level of security and protection as compared to money that you keep in your bank account. They're two different things, right? CBDC follows the cash in your hand model. It basically says that the money that is lying in the CBDC wallet in your device is, because it's a central bank liability, is not dependent upon the bank who's providing you the wallet. If tomorrow the bank who's providing you the wallet was not to be there, this money would still stay. So that is a fundamental difference between CBDC and a bank account balance. It is digitization of the currency note that you have in your wallet, right? Because I said it's a liability concept, it's still dependent upon the central bank. It's still dependent upon central bank to sort of issue and do all of that. Therefore, in that characteristic, it is different from a Bitcoin or a digital currency.
Understood. Neeraj, what are the benefits? Why should a consumer go for CBDC? What are the benefits of using CBDC versus using, let's say, UPI?
Yeah. So I think the answer to that question lies in that why do people hold cash? Right? See, banks and bank accounts and digital payments are so pervasive today. Despite that, approximately 12% of GDP is still held by individuals in the form of notes in India. And that number fluctuates from country to country, but in every country you have a certain amount of money which is being held in the form of physical currency and physical notes. I think one of the and we can get into this, but there's a recent study that RBI has also come out with. One of the defining features is that for small value payments, in almost all jurisdictions, all economies, people tend to use cash, right? Part of the reason has been that, unlike in India and most parts of the world, historically the digital infrastructure for accepting small value payments was not just there, right? It's a very recent phenomenon. UPI in India is also a very recent phenomenon.
Yeah, 3 years. 10 years.
Yeah. Now, UPI is like really after COVID it has taken off,
Yeah.
right? So it's a 4-5 years of phenomena. Even INPS is about 6 years. So it's not a very, and it depends upon the availability of physical devices. People need to have mobile, people need to have an internet connectivity. If you look at remote locations, deep geographies where the banking system is itself sparse rather, the digital payments have not really taken off in that way, right? They're not as prevalent. So the cash comes from the need to do transactions and low value transactions. So if we can replace that cash with digital cash, that's where the thought process is, that over a period of time, all this cash, people will always maintain some amount of their wealth in the form of cash, and whether that cash can become digital.
Right. And so there are a few things that the central bank has done in India in terms of making CBDC easy to use, and some of them are actually quite remarkable. The first is it's a simple wallet. It's very easy to load it. It's very easy to transact. Second, CBDC has been made interoperable with UPI, which basically means that as a consumer, you load your CBDC wallet, you can go to any store which has a UPI QR code, and you can scan that UPI QR code and make the payment. And now the merchant may have a CBDC wallet, the merchant may not have a CBDC wallet. In either case, the transaction will go through. So as a consumer, actually, you don't need to worry about whether I'm using the right app and the right QR and so on and so forth. And so it's again very CBDC acceptance is at any point where there is a UPI QR code, which I think is quite remarkable actually, that they've been able to achieve this quite dramatically. There are two other things which I thought very interesting about how CBDC is being thought about. One feature of digital currencies is the fact that they can be programmed, which means that, as an example, I can transfer some money I can load my son's CBDC wallet, and I can program it to say that he can only use it to buy stuff that is required for his school. So let's say he can use it in the school cafeteria, or he can buy books and he can buy textbooks and so on and so forth. But he cannot go to a restaurant and use it, or he can't use it on, on his mobile device to buy games or whatever else. And that's a very powerful functionality which actually no currency today, no money today offers. And if you think of it as an example for government to say that they are doing some direct benefit transfers and they would like to ensure that the end use is for the benefit that they are providing. And so if the DBT is for gas, then you can program it to say that you can only buy gas using this. And that's a very powerful use case which that doesn't exist today actually anywhere else. And that's something that is kind of right now obviously CBDC itself is in a pilot stage. But I think this programmable nature is something that can.
No, this has been one of the selling points of CBDC, that once you have CBDC come into play, you can actually modify the, you can some sort of put constraints on in what conditions CBDC can be used, who can use it, how they can use it, and that allows governments to do certain things which they cannot do with the traditional bank transfer, traditional cash payments, right?
Correct.
It's something that we will need to see how it plays out over a period of time.
Yep.
To your point on interoperability with the UPI, I think obviously because it's a digital form of money and acceptance requires a digital sort of infrastructure, right? And UPI is the biggest digital infrastructure that we have today. You've got even a small vendor, a small pawn shop guy, a small kirana store having the QR codes where they can accept digital. So it's natural that we link it to UPI to say that okay, it's as good as using your bank account and making that payment at any point in time. I think one thing that we also need to discuss is that the physical cash gives you a certain amount of anonymity.
Right.
There's no track record of how many times a given currency note exchanges hands and for what purpose, right? And in some senses, that anonymity is also one of the reasons why public ends up holding so much cash, right? Because you don't want every transaction of yours to be recorded in some ledger and somebody willing to sort of go through it. The key question is that will CBDCs provide the same level of anonymity that physical cash provides today, right? Now, by definition, it's a digital mode. Every transaction will get recorded. There's no going away from that fact. Therefore, to come up with the same level of anonymity in a digital cash as you have in the physical cash, you will require legislation. You will require laws that will protect certain small value transactions of yours against being tracked. Because if you don't do that, you're not making this digital currency at par with the physical currency that people were always holding, right? So I think that's another important aspect of digital currencies or CBDCs that we need to keep in mind. And while, you've been leading this entire CBDC pilot effort that Axis Bank has been doing with the RBI, but I think that feature is still, in some senses, evolving, right? We're still kind of discussing as to how that anonymity feature will get encoded in the digital currency world.
Right. No, there are obviously many things it's a pilot and there are many things to think about. Anonymity is one. Also, how do you ensure that while you provide anonymity, it is not being used for wrong purposes?
Right.
So, terrorist financing, drug funding, etc., is obviously something that needs to be thought through. And obviously, how kind of, what will it take for CBDCs to really take off, much like UPI has, I don't think it's a settled answer yet. We have some great proof of concepts or ideas that are going on. So programmable is one. Programmable, by the way, kind of goes beyond the government. Right? Like there's some very interesting use cases that can come. So as an example, let's say you are running a transport company and now You have to give money to the truck driver to go from Chandigarh to Chennai, let's say, and the guy has to, fill in petrol or diesel at various pumps. You can give him programmable currency, which then he can't use for other purposes. So, solves leakages. I think there are many, many use cases of this nature that can come out. And the other one is offline, which is today for UPI and the like, most digital transactions, you need access to internet connection. But CBDC, I think soon, or actually there are already kind of efforts going on to introduce it in the offline mode, wherein without an internet connection also you can exchange the tokens, which also can become quite a strong use case for the usage of CBDC. So there are many things going on. Obviously, I don't think it's a settled question that
What the format is.
what the format is. And
So I think in that, if I can just kind of supplement that by saying that there are certain features of the physical cash which have not been fully evolved in the CBDC concept. Right. One is anonymity we talked about. The second is offline usage. I don't need a mobile device to be able to use my cash. I can just kind of take it out of my wallet and make the payment. Right. The third is basically control over what kind of end uses that you can make using the currency, right, and tracking of that currency usage. I think in another aspect of not physical cash, but the payment system is cross-border payments. Right. And the belief is that if you have a good CBDC setup all over the world, it will be easier to connect them as compared to the current payment systems, and provide a far superior user experience on cross-border payments, right? Far superior end experience on the cross-border payments. But I think it's again something which is we're not yet there. The important thing is that CBDC as a concept has been talked about now almost, I would say, 7-8 years. There are 100 plus countries in the world which are currently thinking about or doing some kind of studies or pilots around CBDC. But what form and shape the CBDC will take has not yet been fully agreed upon or solved in some senses, right? Two of the largest economies, which is China and India, both are running currently pilots on CBDCs. Some small countries like Bahamas and maybe Nigeria have actually gone ahead and embraced CBDC as a full-fledged currency, right? The sand dollar of Bahamas is actually the first example. But the most evolved economies, the most advanced economies like US, Japan, Europe, have still not made up their mind as to whether they want to really go down the CBDC path and what are the benefits and what are the downsides of actually going having a CBDC in the first place, right? So they've not even started with the pilots. So my sense is that, again, pretty much like digital currencies, while digital currencies have already been issued and have they already been traded and being used, CBDC is still a very, very early stage concept. And I think some of the features of CBDC will evolve over a period of time. But the concept that, but the idea that the physical cash, which is morphed from a metallic coin to a paper currency, will further morph into a digital form, I think is here to stay.
Right.
So we will see some kind of an evolution of a paper currency into a digital form. And that is still, I think, a work in progress.
Great. Neeraj, thanks a lot for this chat. It was very, very wide reaching. We started with talking a little bit about the history of money itself, and where we spoke about how it has evolved from some real world assets or commodities to a paper note which is backed by a commodity to a paper note which is not backed by anything, and it's a liability of a central bank. We then spoke about digital currencies, cryptocurrencies, their evolution, and the fact that if we contrast the kind of existing currency with cryptocurrencies, the big differences are that the existing currencies are central bank issued and central bank managed, whereas the cryptocurrencies are not issued by anybody. It's actually a broad set of people who are, and anybody actually can go and quote unquote mine these coins. Also, the supply is limited. It is mathematically driven, and there is some activity you have to do to kind of mine it. Whereas on the other side, it is driven by central bank policies, and they can decide when to print how much and so on and so forth. If we were to move to a world wherein digital currencies were to be the mainstream, governments and central banks would lose the power of issuing currency, and hence both the fiscal and the monetary base of managing the economy would be under question. And that's one reason why they are most of them are very skeptical and wary of cryptocurrencies. Cryptocurrencies haven't yet become mainstream currencies. Actually, they become more digital assets. And your view on this is that it is because actually it's very early. It's only 15 years. And in the life of a currency, 15 years is basically nothing. Over time, this could change quite dramatically as things progress. We spoke about CBDCs, how central banks are now starting to look at CBDCs as a way to, as a natural evolution of the metal coin to a physical note to a digital token. And it can carry many benefits for the economy and for the central bank, including things like this programmability and offline and cross-border payments, which are very strong use cases that can propel the usage of CBDCs. You mentioned how many countries in the world are doing experiments and so on and so forth. I think India is perhaps the most evolved in terms of the scale at which the pilots are running and the amount of experimentation that has gone through. Having said that, the entire world and India included are very early in the evolution of CBDC space. And as you said, what form and what outcomes it takes is yet to be seen. But the progression of the metal becoming a paper backed by commodity, becoming a paper not backed by commodity, becoming a digital token seems to be a very natural progression and seems to be here to stay. And it's a space that will be interesting to watch out for. Yeah. Thanks, Neeraj, for that conversation.
Pleasure.
It was a fantastic dialogue.
Thank you.
Thank you. Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.